Welcome back to Mutual Fund Corner. Still have with us Mohit Gang and Kirtan Shah to answer all your queries with this big amendment that has come through as far as debt mutual funds and taxation is concerned. We'll continue to talk about some queries that you all have written to us. Gaurav Bhumaj writes to us from Pune. He asks us if it is wise now to buy bonds directly without any mutual fund route. He also asks what is the taxation for direct bonds, government bonds and corporate bonds. Kirtan, your take on this.
So Sonal, first of course, idea is that when you go and buy a bond, right, the problem with a bond is that the ticket size is slightly higher and for all practical purposes there is no liquidity, right? So let's say if the bond is supposed to mature 5 years from today and you want money at the end of the third year, most retail investors, I can tell you, don't even know where to go to sell the bond, right? So that's one big problem. Of course, you will have a huge influx of people reaching out to retail investors saying that there are high yield bonds available, but always keep these two things in mind along with concentration risk, that you put all your 10 lakh rupees in one bond and if something happens to that company, you know the principal is at risk. Having said that, on the taxation bit, definitely these bonds theoretically have an upper hand now versus the debt mutual funds, because if there is a listed bond, right, and if you hold it for 12 months, you are only taxed at 10%, right? And even if it is an unlisted bond and you hold it for 36 months, you are taxed at 20%. So for somebody who's in the 30% tax bracket, this looks a lucrative option. But I'll tell you a problem here with the theoretical math, that if you buy the bond when it is issued and you hold it till maturity, there is practically no capital gains, right? So the interest that you receive, you are still going to be taxed equivalent to an FD or now a debt mutual fund, right? And because there is no liquidity and the retail does not understand when to buy and sell to make capital gains, retail will really not be able to take advantage of this tax differences that we are talking about. So largely all said and done, I think the retail will not be able to make a lot of out of this, even if there is a small tax advantage versus the debt mutual fund.
Yeah, no, that point is completely taken. Mohit, I want to come to you on this as well. Take us through what you think. The question is, should you directly buy bonds? But it doesn't take away from the fact that, you know, a debt mutual fund is still a professionally hand-picked, set of bonds.
No, I think what Kirtan said is absolutely right. And just to supplement that, look, when you go and buy bonds directly, you have to be perfect in terms of knowing the credit quality of the bond, assessing the company, its management, and knowing a much more detailed. It's like going and buying stocks directly, and why do you want to buy through a mutual fund? The same logic applies when it comes to debt. You buy through a mutual fund because you get professional management, and obviously the fund manager is not just making returns by virtue of approval or the coupons. He's also trading in and out of the bond. He's moving up the yield curve or going down the yield curve and trying to enhance those returns. So I think those added advantages are there. One more point which we are missing in this entire thing is that mutual funds will continue to provide you set off gains or set off your losses in succeeding years, which a fixed deposit or a bond will not be able to do for you, right? So when people compare fixed deposits, yes, the taxation is now at par, but in mutual funds, you can carry forward your losses, or if there are existing losses, you can set it off against your gains. So that added advantage will continue with mutual funds, of course, and the yields remain a little higher because of the fund managers trading in and out. So to my mind, honestly, I think mutual funds and debt mutual funds will continue to remain a good investment avenue. However, they will lose a lot of sheen because of this whole tax impact, and maybe some of the HNIs might prefer a direct bond route or some other route, perhaps arbitrage or some other equivalent opportunity, which time will tell. But yeah, I think there is some impact.
Mohit, let's talk about the second level impact of all this, because we have spoken how it could move to other categories. Would it move to a different asset class altogether?
Oh, yes, absolutely. And I think in all these changes, Sonal, it's a great question. I continue to believe that when regulators bring about these changes, they sometimes fail to imagine or anticipate the second order and the third order impact of this entire thing. Now, just to come at a basic Indian household, he will first go and invest in an FD, and then he was going and investing into mutual funds. It wasn't the other way around, that investors were first investing into debt mutual funds, and if there was surplus, they were going into FDs. It was FDs first and then the debt mutual funds. Now, once you close that avenue for him, what will he do? Perhaps he might still start moving monies to physical assets, right? The money can move into real estate or even physical gold, because that continues to give him indexation advantage. If you're plugging the indexation advantage on mutual fund or gold mutual fund as a category, you might just plug it on physical gold also, right? But that's still open. So investors can translate or move that money into physical gold or perhaps into physical real estate. Let's say REITs and InvITs can again become a popular category in this scenario. So to my sense, investor behavior will change dramatically. I think one very big impact which this might see is tax planning, perhaps for a personal finance guy like me, or when you do retirement planning, there is no long-term safe avenue available now which can fight inflation. There is not a single instrument left now which will give you inflation adjusted returns or higher than inflation adjusted returns on a long-term basis. There's only PPF left, which also has a finite limit of investment. So the entire investment psychology or investment behavior might change. It might dissuade some long-term savings from moving into debt. Retirement planning for people will get difficult. Corporate bond market might get impacted. A lot of money was moving into instruments like Bharat Bond. It was a big source of revenue for government to collect monies. So these are all second order and third order impacts. These will all play out in few months, and no one knows how the entire industry will be transformed. But to my mind, this is a very, very significant tectonic shift in behaviors of investors.
Oh, absolutely. And this is a really concerning point as well, right? I mean, we've spoken so much about where has money moved, does it move to hybrid, what will happen with the flows, but what will happen to someone who now suddenly has to change the entire retirement planning situation? So all of that are, those are important points to consider. But Kirtan, Mohit, it's been a pleasure to have you on this show. Thank you very much for taking out the time for, really speaking to all of our viewers as well and addressing these individual queries. We're going to wind down on that note, but you stay tuned. We have lots more coming up.